All right, so stocks finished the week on a down note with what was happening over there in Eastern Europe with Ukraine and Russia. The markets didn't seem to like some of the headlines that came out over the day, and you also have options expiration, which impacted some volatility. You also have the FOMC minutes or meeting that's coming up. Interestingly enough, the odds of a rate hike in March actually for a 50 basis point rate hike in March actually dropped pretty considerably in the recent past. That would have been pretty bullish for the markets, and obviously we saw today wasn't enough, right? It wasn't enough to offset the geopolitical. So we're going to talk about today, how whether we're in a correction or not, and what do corrections look like, and when do we know when one is over with. So we're going to break all that down. We're going to take a look at a trade idea for a stock that has been relatively bullish, but is showing some bearish rolling over. Doesn't have very much of a directional opportunity, so we're going to talk about how to still trade that from a bearish perspective. Anyway, so let's go ahead and get started. Today is Friday, February the 18th, 2022. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, another down day, second in a row, closing below this week's low point that we had previously on Monday morning, and also closing below the 23% level. Now, if you look at SPY, just kind of give you an idea, in the after hours, we traded down here to 432.27. So we were off the lows here, but the low was at 431.82. So we actually ended up closing a lot closer to the low, at least in the after hours here. By the time it was done, the after hour session was done, we're actually a lot closer to the lows. I mean, in fact, if you look at right now, I'm at 432.25 right here, and you can see that's pretty much sitting right on the low point there. So it was a relatively bearish day. You can see short-term sentiment was down. You see both the near-term line and the momentum line got down to oversold levels. The momentum line avoided being extremely oversold, but again, that's a function of coming off that low point. So it might not be ended up being as bearish, or as it might be ended up being more bearish than what we thought. And then you can see the near-term line also dipped to its lowest level since the cluster that we got back pre-expiration date there. In fact, there's a couple expirations in a row that we finished, well, multiple. Like there's a couple down days going into that expiration right there. These two down days there, these two down days there. So it's been a relatively bearish moves lately going into expiration. That's been atypical. It's been usually the other way around lately. It does kind of maybe show a change in the sentiment, right? When you're in a bullish market, you tend to go up into, but even there's a couple down days. Well, actually kind of through expiration, both before and after. But last time we actually came out of expiration with a pretty significant down day, but then rallied off the intraday low, really strongly off the intraday low, and then pushed up by the end of the day and ended up setting a low point there. So we'll see if that ends up being the case again today. Or going into Tuesday in this case, because of the holiday. The market sentiment line has dropped below 50, so we haven't seen that for a while. Last time we dropped below 50 was quite a while ago, actually. If I were to zoom in here, you could see it was all the way back here, and it was just a brief dip. By the time we actually dropped below 50, we already had dark green shading and a green line by the time it actually got there. So, I mean, that's how brief that was. It was just a intermediate decline there. Before that, it was the COVID low point, where we actually did get significantly below the midpoint, and before that, it was fourth quarter of 2018. So another indication of how this is very similar. This is a corrective move, because obviously we're below 50, and we don't have dark green shading and a green line. So we're not ending this correction anytime move. We had a really good discussion in my technical analysis class about what corrections look like, what do bottoms look like, and what does volatility do during these corrective moves. And so if you're a premium subscriber, I highly recommend. If you haven't watched it yet, the recording's out there. You check that out. It was a really, really good discussion. Let's take a look at some of these other indexes. If you look at the NASDAQ 100, its market sentiments, and not just in below 50, but it's also below in bearish territory. So again, another indication that we are in correction mode. And the Russell, when you look at the Russell 2000, it's not only been below 50 and in bearish territory, it's been there for about a month now, like since the last expiration date. So we've been bearish. In fact, it got into the lower reversal zone. That's how bearish. And shoot, at one point in time, the Russell was over 10, or almost 10.5% below the 30-day moving average. It's a pretty significant decline for the Russell. And you notice that too, that again we had come up during this little retracement to the upside. We got that yellow shading, light green shading and yellow line, but we did get up there and then pulled back already back below the 23% retracement level. So we're kind of and all the indexes have. You can see the SPX is also closed below the 23% level. If you look at the NASDAQ 100, it's also closed below that 23% line of this retracement, as well as that long-term 23% line of that bullish run, the post-COVID run. Big long-term run. This market sentiment line is also in bearish territory, just starting. So again, another reflection of that we're in a correction here, that we're not just in a typical pullback, intermediate pullback, where the green line gets in the bearish territory and that's it. Looking at the weekly chart, you can see that, like I said too, another indication of that we're in a correction mode is the green line is in bearish territory itself. See, it did that in COVID, it did that in the fourth quarter 2018, finished with a cluster, it did it in 15 and 16, and it did it in 2011 and 2010. Those are all the major kind of corrections that we've had since the bull market low point here. So we are there again, and short-term sentiment bounced. It actually already bounced. See, when you look at something like this one over here, by the time short-term sentiment bounced, the near-term line bounced right back into bullish territory, and so we ended the decline. That was that first quarter 2018. That was pretty significantly bearish. Fourth quarter 2018 too, you can see when we got in the bearish territory, we had a little bit of a rally here, and it didn't quite get up above 80, and we came down, and a little bit of a rally there to get out of bearish territory, but stalled and turned back down. So that's kind of what we get right now. Like, we've been in this decline, we got a little bit of a near-term run, got its toe above the 40th or 60th percentile there, 60.22, and is already back down in the bearish territory. So we got dark pink shading and a red line. See, we don't get that very often, dark pink shading and a red line, but we have that now. We actually have had it for a while on the Russell, the dark pink shade. We actually got a cluster too, but its market sentiment still way up here. Intermediate line in the reversal zone, very similar to the COVID drop. Dark pink shading and a red line for a while now, and then you look at the NASDAQ 100, it's starting dark pink shading and a red line. So that's that's a significant bearish pattern on the market forecast. And then now that we're done with this month, we can look at a monthly chart here. Let's look at the monthly, again, not monthly, but options expiration. So monthly, but we're going to go up, from start to finish, and look at that. Look how bearish that near-term line got on this particular short-term sentiment line. Like, we haven't been this bearish on that near-term line, getting down to below the 5th percentile. We haven't had this bearish of a month since that one there in November 2018, that expiration cycle that ended right there before Christmas, when things were really hitting the fan there. The momentum line also dipped to extreme lows, just like it did not this expiration cycle, but the last one there that ended here in January of this year. But I mean, you go even to 0809, the near-term line never got that low on an options expiration basis. In fact, the last time we did was actually 05 during a bullish run. So it's kind of shows just how significant this is. If I were to go all the way back to 1980 and look at when we were up here, you can see the near-term line also during some of these bearishness runs was starting to get bearish with some extreme oversold levels when we were really bullish. And it kind of changed, right? Well, again, the intermediate lines cross below market sentiment, but they're both above 80, so it's not nearly that significant until we fall below that. See there, the correction mode here, the intermediate line dipped below on COVID. It dipped below fourth quarter of 18. It dipped below 15 and 16, and it dipped and almost dipped below there in 2011, coming out of that one. So for us to if we're in correction mode, that would be the intermediate line would be dipping out here. But again, when you're in bear market mode, it dips out and drops, right, and gets into bearish territory. And so we're not anywhere close to that. But that short-term sentiment, if this were a daily chart, then that would tell me to expect more bearish, like we're going to be bearish here for multiple days. And there's a good chance that we can make the intermediate line run down out of bullish territory as a result. That's what you would expect in a daily chart. Now keep in mind, this is a monthly chart, so every period here is a full expiration cycle. So before if we did get the intermediate line to come down to bearish territory, it would be potentially 6, 7, 8 expiration cycles for it to do that. So it's not gonna. We're not talking about the market tanking in the next couple of weeks here, hardly at all. But it does show just how bearish we are and how this sentiment has changed and how it's going to be hard to buy the dip in this case because the dip is so much more. There's been a much more significant change in sentiment on this dip than there has been on any of these others, right? Even again going back to 2018, at the end of it, it wasn't that bad as it is right now on a near-term base, on that near-term line, on this particular monthly chart. All right, let's take a look at the other weekly chart we look at, and that's this. Oops, not this one. We'll look at this in just a second, but if you look at the S&P here, you can see we are getting close to a death cross. We already have it on the Russell, right? There's your death cross on the Russell, and your NASDAQ is actually really darn close. I mean, we are easily below the 40-week moving average. It's actually falling. So we'll probably get, and we're just barely positive right now as it is, we're probably going to get a crossover next week, assuming we stay negative in this differential. So the PPO is falling to negative levels. Again, you can see how often the PPO between the 10 and 40 actually gets negative. There's COVID. It didn't barely got negative. There's fourth quarter 2018. There's 15, 16. There's 2011. I mean, it got barely negative on all these, and you can see the bear market, so it gets a lot more negative. And even there in 06, when the housing bubble burst, it got pretty negative in that case. So you would expect that we'll be probably pretty negative here for a while, considering that we haven't got the death cross yet, and we're almost we've been below the 200 for a while, and we haven't got the death cross yet. So I would expect that we could be bearish here. That's the NASDAQ. And then your S&P 500, you can see we're still 2% away from having a death cross, but we are trading below the Hakinashi close isn't there, but the actual close is below that 40-week moving average. So it's more significant to get that. Well, the Hakinashi did close below it, so that's more significant than even the regular close because it's an average, right? It's an average of 4 levels. Now let's take a look at one more weekly chart, and that's this one. Let's go to the weekly version of this for the S&P. And you can see, again, on this chart, a correction is defined by the getting between the 50 and 200-day moving average, right? Those are your corrections. You can see them all here, 2018 and 2020, 2018, 2015, 16, and all the way into 2011 that you don't see there. So MACD gets negative, stochastics gets into bearish territory, and we get in between the gap. The difference between this and any others is the gap is bigger than it's been since the late 90s. There's only been two other times the gap has been bigger than this, late 90s and 1987. And in both those instances, we filled in the gap. We filled it, but it took more time in the late 90s than it did in the Great Financial Crisis because the gap wasn't as big going into the Great Financial Crisis. So that's a pretty significant gap, and like I said, you'd think, well, there's no way we're going to fill it. Yeah, we can. In 1987, we filled it in just 2.5 weeks. We filled it, and it was bigger than this on a percentage basis. So we can fill it, and if you look at like IWM, we already have. And you remember ARK Investments, I've shown you, again, as a proxy of the most speculative end of risk appetite, you can see it's already actually below its 200 weeks. So it actually has corrected and is below its 200-week moving average. So it is, then when they talk about deep value, that's what they're talking about. It's already corrected what on the other end of the risk spectrum, large caps and especially blue chip stocks are just barely starting, right? The Dow has just barely crossed below. Last time it was just a little bit below. Now it's a lot more below. to the point where the 8 and 17 over here, the 8 and 17 moving averages were still above the 30-week moving average. Now the 8 and 17 weeks are actually below the 30-week. So that's a lot more bearish than what we've seen. And you can see there's not very much volume here. It's going to be very easy for the Dow to fill in that gap because there's not very much support from a volume standpoint. Only Fibonacci support there at 298, based on that 38% retracement. I'd venture to guess by the time we got down to the 200, it'd probably be around that area, as well as that pre-COVID high point. It would be where you'd end up eventually finding some support on the Dow Jones. And like I said, the Russell 2000 has already come down to its 38% post-COVID retracement on an intra-week basis from a few weeks ago. And so you would expect, the next layer of support for it would also be its pre-COVID highs and fall 2018 highs, which would be the 50% retracement of the post-COVID rally, where there's a little bit of a shelf of volume there. It can also add some support at 170. I think that's, again, kind of worst case scenario, 170 plus or minus, a few bucks, because support and resistance is a range and not an exact level. So those are the weekly charts. Let's take a look at the daily here on this one. And you can see, it looks like there's our consolidation pattern, a nice little wedge going into the moving average. And now we're back below the 8. We're back below that 23%. It looks like we're rolling over. In fact, if you look at the whole moving average chart that I've been sharing with you here relatively recently, if you look at IWM, it has rolled over. And I tweeted this out earlier today. You got the parabolic SAR switching. You got the Hakinyashi turning bearish with no upper shadow. So you kind of had a bearish last week, but we had an upper shadow. So no upper shadow now. A good, strong bearish candle on a Hakinyashi basis, which is a smooth candlesticks. The parabolic SAR also kind of smooths out the trending moves too. And then the whole moving average also smooths out the trending moves, as you can see. And we just barely turned. Barely turned there. So you got all three things occurring, as well as a close back below the 23% retracement all today. So it would suggest, it doesn't guarantee, there's nothing that's ever guaranteed, but it would suggest that we might be making a new leg lower right now. Remember, SPY already actually has done that. Let's see if I go to SPY. It flipped over a few days ago, like last week. It actually flipped over last Friday, or no, Monday. It looks like it was Monday that everything flipped. The parabolic SAR moved up. So Monday we flipped over, and you can see we're continuing, and we got a good bearish Hakinyashi candle here today with a big body too. And then Q is the same thing that actually flipped over on last Friday, as when it flipped over, and it's back to having some pretty strong bearish Hakinyashi candles here. So that and the whole the change to the bearish has occurred below, with the red 200-day hull instead of a green 200-day hull. So it's a pretty bear. Like it appears that we're making new legs lower to the downside. If you look at the DMI for SPY, we are easily above 30. The ADX is making a run up to higher levels. IWM, the ADX actually pulled back to 20, and it looked like we were going to flip around, right? But now we're potentially getting back above 25 on the negative indicator. We already are below 20. You notice on the weekly chart, we're not too extreme yet. When you get down to these below 10 is when you can signal a bottom here, and we're not quite there yet on the negative indicator. We have to have a little bit more of a run, and we're especially not there. Like on the Dow is not anywhere close to 10, and SPY is not anywhere close to 10 too, and those are kind of marks the bottoms sometimes, or more often than not, of corrective moves. When you look at the RSI and the CCI, you can see back to bearish territory for the SPX, back close to bearish territory for the Russell. Your NASDAQ is back to bearish territory, below 150 there, below on the CCI, below 37. Looking at the Ichimoku cloud, SPY is still hasn't started a new bearish trend yet, so it's still kind of relatively noisy from that perspective. The Qs are still in a very mature bearish trend, and then IWM also is still relatively noisy and hasn't started. But you see how they're all easily below the Ichimoku clouds. The clouds are pink, and we're definitely in bearish mode, and that's on the daily chart. If you look at the weekly chart, we are in the cloud on IWM. We are not in the cloud yet on SPY, nor on the diamonds, and the Qs, we're just getting into the cloud. And you can see the long-term bearish trends have just barely ended, or bullish trends have just barely ended. on the Q. So it kind of gives you an idea of where we're at there. Finally, on the short-term charts, you can see the lower high, low, closing below last week's low point, closing below yesterday's low, so bearish closes there. If you look at the volume, the trading range today was average, the volume was average. Volatility was not very strong. And that's pretty crazy for volatility to not be very strong. Now, expect that it will jump up Monday because it typically jumps on Mondays. So expect that it will jump up. But the fact that we are below the 200-day moving average, the fact that we are starting these correction moves and we're not above 100% on volatility relative to VIX 3M tells you that we are probably in the correction type where volatility grinds its way up. Instead of spikes up and we set a low point and then we just stay at the low, it grinds its way up and we just kind of trend, we start to trend higher. If I were to look at the VIX on this chart, you can see we're just trending higher right now. Look at all those moving averages moving up. That's on the daily chart. The weekly chart, same thing, right? So it appears, you know, that we're now trending to the upside on volatility, that we're not just spiking like we did with COVID. We're going to probably be moving, gradually moving up over the course of however many expiration cycles it takes to finish the corrective mode. And it won't be nothing but down days. Remember, not only do you get big down days during corrective modes, but you also get really big up days too. Not, you know, you don't just get big down weeks, you also get up weeks during corrective modes. So don't, you know, it will have good days, we'll have good weeks, but that won't necessarily mean that the correction's over with, right? So what do you think? Do you agree with that? Do you disagree? Let me know in the comments section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. Subscribing to our channel will make sure you get email notification or notifications when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today, of course. And it tells us you want us to do another video again next week. Quick way to give us feedback if you like our stuff. Also, comment down there. What did you get out of the videos today? What stood out to you? What questions or comments you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things on the right, including our Market Outlook live video. Click on this image. It takes you to this page on our site. You can see all the live videos that we do here. I do this at 3:30 Eastern Time, Monday, Wednesday, Friday. It's a quick 10-minute video. I basically just look at all the trades we've done in prior Market Outlook videos to see whether or not we should stay in them or get out of them. We actually got out of a couple today, so check that out. We also put on today's trade idea. You'll hear at the end of the video. We already put it on today before the market closed. So that's a benefit to watching these videos. You can get to it also up here by clicking on Live Trade Review in our main menu. You can also see our upcoming classes. Click on View More right there. That takes you to our calendar. You can see our upcoming classes as well as our recordings, past classes going back almost 4 years. If you look at, come down here to the bottom, click that heart. It opens up this tab. Hit that like button. Click on the thumbs up icon. It opens up this tab. I don't know why you can't see it now, but you can click on the like button there when that does come up. Again, that helps us get our content out to all of our followers. The more you like and engage with our content. It also helps you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching. All right, now let's talk about what's driving this price action. Let's come back to just today alone first. So we'll go to, today alone. Then we'll take a look at the week that was. But you can see long-term bonds rallied, commodities rallied, which is not necessarily an inflation trade. Usually bonds fall in an inflation trade, but bonds rallied. The dollar was up quite a bit today. 0.25% is a big move for UUP. Equities across the board were down, including emerging markets, down pretty significantly there. Gold was down just a smidgen with the bullishness in the dollar there. Now let's zoom out to the whole week. Remember, this has been a down week, right? And you can see there's the Q's down 1.6%, IWM down 0.9%, and gold having the best week, not surprisingly, because that's kind of where the problems are. A lot of the weakness right now is kind of stemming from is stemming from the geopolitical issues going on in overseas. Let me see how many weeks we need to go back. So let's go back let's go back to, let's see, this would be the first day. So that first day of the year, essentially, which was actually an up day. So we'll go to the second day here. From this day going forward, we've been down, right? We started higher, and then we worked our way down by the end of that day, and so on, and we've been down ever since. Okay, since the beginning of the year, essentially. Now, again, you can see that 15%. If I were to actually go to the actual beginning of the year, see where it was an up day on that first day. So going from that first down day all the way through, the Qs are down 15%, IWM is down 11.5%, so a little bit of a difference there. Real estate's down pretty hard, which is surprising in an inflationary environment. Gold and commodities are rising, which is not surprising in an inflationary environment. The dollar is down. Emerging markets are actually really outpacing U.S. equities. I mean, the emerging markets are only flat on the year. They're doing very, very well, outpacing developed markets and way outpacing U.S. with the S&P 500 down 9%. But then bonds are down 4%, which again, very typical of an inflationary environment, of rising inflation. And that's what we're seeing: rising commodities, rising gold prices, relatively falling dollar, weaker dollar. Currencies are better than equities when you use UP as a proxy for currencies. Currencies are outperforming equities, so cash, right? But they're not outperforming commodities or gold or physical, tangible assets. They're outpacing. So, except for real estate, of course. And so you can kind of get an idea here of the weakness, and you can see we're kind of moving down to new lows, or making a new leg lower at least. And this is how low we already are down before we even get really going again on a correction, right? We haven't even, again, like I said, we're just barely starting a correction, and this is how far we're down from that peak. Now for the Russell 2000, the peak actually started much earlier than that. Remember the weakness. We started the weakness there on that Friday after Thanksgiving from a broad market standpoint. So you can see, we did come up to new highs afterwards going into that first day of the year, and that's when it started to decline. But from that Friday after Thanksgiving, look at that, small caps and the Qs are actually down together by the same amount, roughly about 14%. Gold and commodities higher, the dollar down, and real estate outpacing equities, at least the further in scale of equities. This would be now more reflective of the diamonds, which would be on the other end, on the more safe haven area end of this risk appetite spectrum. And then, of course, international equities have really been outperforming. 3% down for emerging markets relative to 14% down for emerging markets. Let's take a look at the 12 grid for these different asset classes. And you can see the dollar's been relatively flat, up and down, but relatively flat. In fact, the intermediate line ended up going nowhere. It was like exactly sideways. That's why it's not shaded, because it went exactly sideways, which is rare. Gold, you can see, is on a bullish move. The long-term bonds actually rallied coming into the end of the week there. But look at global equities, dark pink shading and a red line, just falling into bearish territory too, below that 40th percentile. Same thing with developed markets. Emerging markets aren't so bad. Also went exactly sideways on the intermediate line, which again is extremely rare for that to happen. And then you can see, you can see bond yields. You can see crude oil. You can see Bitcoin really rolled over. That's another asset class that's associated with risk appetite on the kind of higher end of that. And look at that drop back down. So we got the death cross. We actually got a test of the 200-day moving average, in this case the 50-day moving average, right below it, and we've rolled back down below 17 yesterday, and then kept it down, and back down below the 30 today. So the MACD has crossed below its moving average. You got the red arrow on the histogram, and the MACD itself, the blue line, is almost about to cross below 0, which would mean the 8's about to cross below 17, and then they're both really close to crossing below the 30. And again, we are in, there's different stages to this death cross, right? First is price, then eventually it's the 8 and 17 day, then it's the 30, and then it's the 50. Right? There's stages to this. So we have all the stages here for Bitcoin to be in this bearish run, and we're almost back to a new leg lower to the downside. All right, again, looking at the euro US dollar as a proxy for the dollar is about as flat as you can possibly be here. The MACD is down. In fact, the euro closed back down below all those moving averages. In fact, except for the 200-day, all the moving averages fit inside of today's range. If I were to look at the hull on this one to try to smooth out the trend, you can see actually the 200-day hull for the euro US dollar has turned up. So it kind of gives you an idea, that's a little different picture than what we kind of look like, because the 200-day moving average, the simple moving average, is way up here, right? That's the big difference. When you look at that chart on the euro US dollar, you can see the 200-day is way up here at 116.5, and it's falling 116.5. But when you look at the whole 200-day moving average, it's way down here. So 116.5 is right up there. So it's down here, and it's actually turning up. And we have, the parabolic SARs are bullish. We did, kind of drop, and we're close to flipping it. We got the bearish candles, we got a bearish hull, but we haven't quite flipped it yet. So really important to see what we end up doing. I mean, we got upper and lower shadows for the past few days. So we don't really have bullish or bearish Hakunashi candles right now. So let's see if on Monday this doesn't revert back up to the upside here. And stay and keep the parabolic SARs down below us and get a bullish candle. So we'll keep a close eye on that on Monday to see what the dollar is doing. Again, the expectation is in an inflationary environment, the dollar drops, and the euro in this case would take off to the upside. So we'll see if that ends up being the case. Let's take a look at how the sectors performed here. Let's do the regular chart. Oops, sorry, not this one. The comparison chart first. So let's come down here to the comparison and look at just today alone. Staples, financials, materials associated with gold, right? Utilities, safe havens with staples and utilities. Financials doing pretty well, even though bonds have been rising, but yields are relatively high, sitting at that 2% area. Discretionary communication services, discretionary at one point today. Technology, all lagging behind. And if I go out to the whole entire week here, you can see, there's energy has actually been, but we know why energy's down this week, because it's been one of the best performers. You'll see here in just a second. Communication services down, financials have been down, healthcare has been down, and staples is the only one that's been up this week, along with materials associated with gold again, and then in commodities, and then discretionary. Let's zoom out to the beginning of the year. For that first day we started to go down, and look at energy. That's why energy was down this week. And I expect actually energy is going to probably have a little bit of a struggle now. When you look at this chart, let's go to this chart here, and let's look at energy, XLE. You can see we are converging. So the MACD is below its moving average, so you have a negative histogram, stochastic's falling. You are still above the 17-day though, so we're not breaking down yet. That's what happens. You can see eventually happened right there after converging that entire time, and then that's when things went bearish and we filled in the gap between the 50 and the 200 day. So we're not quite there yet, but you can see the gap's actually bigger now than it was then. You can see there's a wide gap there on volume. On a weekly chart, we have just barely gotten above the 200 week. The 8 and 17 have crossed. The 30 has crossed. And remember how I said usually when the 30 crosses, you tend to get, by the time the 30 crosses the 200, you usually kind of get a counter move before you continue the trend. In this case, the counter move would be back to the downside. So I kind of actually expect that energy will struggle a little bit as it pulls back towards the 200 and the 50-day moving averages now that the 30 is crossed. As we retest, we get a golden cross here on the long-term chart, and we retest, and then we get moving again to the upside. So that's kind of, I expect that we'll have a little bit of a bullish divergence, or bearish divergence here at this point of control for the 5 years, and then work our way back down to, would also be down to the 200-day moving average in that case, before we find some support. So I think energy will outperform over time. But I think right now it's been so overbought, I wouldn't be surprised if it starts to give back some of those really, really strong gains that it's had. Like I said, since that's a big gap in gains that's had since the beginning of the year. Again, I think it will still stay above everybody, but I think it will shrink that gap a little bit. As some of these kind of moderate, maybe pull their leg low, pull a new leg lower, but this has the poorer margin of safety right now. Remember on the 1 year chart, and when you look at the 1 year chart on here, remember there's a very poor margin of safety back down to where the 200 moving average would be by the time we got there to it, right? If we end up doing that, of course. Nothing's 100%, but if we do, you can see we're converging, the volume's declining, so a good chance that we're going to turn this convergence into a new divergence to the downside, and at least fill in the gap between the 30 and the 50, if not eventually between the 50 and the 200. All right, so for our trade idea today, in today's video, I wanted to take a look at Visa. So let's take a look at Visa here. Visa market forecast. It's still relatively, it's got a light pink shade and a green line, so we're not declining hard, but you notice that you've got the near-term line down to its lowest level since it went bullish. That's the lowest near-term bottom that we've seen well into the oversold territory. The momentum line has gotten pretty darn low too. It didn't get below the 5th percentile, but it got pretty low too. Intermediate line has dropped. Market sentiment is barely getting the bullish territory, so it's very weak bullish move right now. It's still very susceptible to some weakness considering the long-term trend. When you look at some of the other charts, some of the other oscillators, here, let's go to the 3 green arrow chart first. You can see it's also like it is breaking. So we had been in the bullish convergence too until today. It broke the 17-day, and it also happened to break below the 200-day moving average too. And you notice it's got a lot of volume above us, tremendous amount of volume over the past year up above you, and not as much below you until you get down to some of these other levels here. And you remember we've had a death cross, we are still in a death cross, and now may be considered here a bearish retest, potentially failed retest of the 200-day moving average. When you look at the DMI, you can see that for Visa, the negative indicator, which had been above 25, appears to be trying to make a run back up, with the positive indicator dropping and almost a bearish crossover there. Looking at the RSI and the CCI have been in bullish levels, are now not in bullish levels and flirting with getting into, the CCI is already at lower levels. Not so bullish there. When you look at the Ichimoku cloud, we are well above the cloud, but there's a pretty decent, the blue line here. If you look at the blue line, it's sitting right on top. Here, let me get rid of this drawing here. So it was sitting right on that moving average. So there's the Fibonacci retracement level. So it's sitting right on. Here we go. See, it's right on that line. So there's some obvious support. It's also where the cloud is. You have the beginnings of a bearish trend. You're above 50. You're below -1, just barely. So it's about the weakest of trends that you can have and still actually be a trend, right? Because you have to be above 50. You have to be below -1 for a bearish trend, and be above 1 and above 50 for a bullish trend. So you're getting the beginnings of a very, very weak trend there. And from a Bollinger Band perspective, what's interesting too is the bandwidth is extremely high. That was a big breakout post-earnings, extremely high, and we are not following through. It got you up to the point of control. The resistance so far is held. And like I said, we are in a bearish divergence right now, the beginnings of one, on that MACD indicator. And the bandwidth is extremely high, the highest it's been in the last year, and is now starting to decline, which means typically when it comes to decline, it starts to kind of gravitate around the middle of the range that this bandwidth, this wide bandwidth, is produced. So that would be the low end, that would be the upper end. And considering a lot of the volumes above you and not as much volumes below you, you'd expect that it'd be hard to go up and easier to go down. But how much we can go down, that remains to be seen. So I don't want to make a huge directional trade here. But what I want to do is come to its March options and look at doing a bear call spread. So selling the mid-30s delta, selling the 230, buying the 235 for protection. This is what it looks like when you look at the chart here, going out to March expiration. So as long as it stays below 230, we make our money on this trade, and that break even is actually up above. If you were to go back to this chart, that break even there, you'd have to get back up above the 200 and all these moving averages and get back up above the, there's my break even right there. You'd have to get back above that point of control. So it'd have to really break out to the upside and change this trend for us to get to close out the trade. And if we can get 50% of maximum gain here relatively quickly, if we can get 50% of that gain, then I'll take before, it has to be within the next week before there's 20 days expiration, then we'll take it, right? And then we'll use that capital, in this case $1,000, to try to make a full maximum gain on another trade and see what we can find. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. You can also subscribe for free to our website at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and a great holiday weekend on Monday, and we'll see you all next week.